Hey YouTube, so I'm making this video today because I saw a comment, I think it was on a live stream, and it was a gentleman that asked about a low dollar stock that was paying dividends and whether anybody was invested in it and if they thought it was a good buy. Well, I got to thinking, a lot of us as new investors, we will look at cheap stocks, right? Under $5, thinking, you know, we'll get more bang for our buck if we buy something, trading at $2 or $3. Well, as dividend investors, I'm here to say that stock price doesn't quite matter. Okay, now there are some solid dividend stocks out there under $5, and I got 3 of them here for you. But I'm going to show you the way you probably should be thinking in terms of a dividend investor. Now, the first stock we're going to talk about is Office Depot. I've been an Office Depot fan for quite a while, and they are cheap. If you look at their forward PE, they're trading forward PE of only 6. They do pay a pretty decent dividend of 4.1% at today's prices. It does go up quite a bit because they kind of trade down in a range. They're kind of on the high end right now, actually, of their normal 52-week range. But 4.1% dividend, no dividend growth, and they're in a depressed industry. They're definitely closing stores. Their sales have been decreasing a couple of percent year after year. But sometimes closing stores is okay with retail, in a sense. If you're closing unprofitable stores, then okay, you lose some revenue, but you gain profit. So that can actually have a positive impact to some degree. Now, Office Depot, hopefully they have a partnership with Alibaba, but I haven't been able to see a whole lot about them and what it's actually doing for Office Depot. But something needs to happen to stimulate their growth or to become more profitable. They are a profitable company. They're just not growing. So they need to find, closing unprofitable stores, finding partnerships, increasing their e-commerce revenue, things of that nature. So, can they do it? I don't know. So they are a buyout candidate. You know, they rejected a bid a while back for Staples to buy them out, and they probably missed on that. They probably should have done it, because now they're really struggling to find their place and to find their way. Will Alibaba buy them out? Will Amazon buy them out? What's for what though? That's going to be the issue. So, but Office Depot has a pretty solid balance sheet, does pay a 4.1% dividend. If you believe in what they're doing with Alibaba and shifting their focus from closing unprofitable stores and things of that nature, it might be something you look at to be a contrarian. They were trading at $1.20, low ones, 120 or so, not too long ago, and they've definitely doubled, almost tripled in the past few months. Now, stock number 2, just FYI, I have been an ODP investor for a while. I'm not in the stock now. I do trade in and out of it every once in a while. So next stock up is in financials, and this is a Santander. I think I said that right. It is a global bank, a diversified bank. A lot of exposure in Europe, Spain, and a little bit on the east coast of the U.S. They have a forward PE of 12.5, dividend of 6.2% with 13.5% 5-year dividend growth. Now, banks are a little complicated for me, especially as large as these guys are. They are expanding. They are, on the East Coast, I think New York, Florida, a couple East Coast states. I'm not 100% sure, but I would imagine they keep on expanding. But they're complicated because they're so huge, and then you got some Europe issues in there. But out of these three stocks that I'm talking about, this is probably the healthiest one, because a bank is usually, when do banks go away? Too big to fail, right? My last stock, before I talk about my last point, is Cedar Realty Trust, ticker symbol CDR. I have been invested in this. I sold out when the price spiked. It is cheap for a REIT, but it is a small cap, could be considered micro cap. It's a price to FFO of 6.56, which is very cheap for a REIT. It has a 6.6% dividend, no dividend growth. Stable business, but slow growth. Now, what the Realty Trust is in grocery anchored shopping centers. So it's going to be stable, but there's going to be slow growth. And with that said, that's why I put on here management. Can management figure out a way to grow their portfolio? Can they get into some mixed use properties that have grocery and, either office or residential, mixed use, entertainment, that type of thing, to spur some growth in there, because they've been pretty stagnant. But they are a good buy. I've been in and out of them all of 2019, sold for a profit, and I'm waiting for them to give me another opportunity, because I think out of all three of these, this is probably stable, doesn't have global risk like the bank did. So that's what I'm looking at. But now the key is, if you are a dividend investor, you end up looking at these $2, $3, $4 stocks, because you think, hey, I can buy more shares of that, and it feels better. It feels like you're doing a little bit more, right? Like you're getting more for your money. And we'll do this little calculation here, because I'm going to tell you that it's not true for the most part. So we'll take Cedar Realty Trust. They have an annual dividend of 20 cents. Okay. Then you have BP, which is British Petroleum. I mean, you can do this with any other ones. I just grabbed BP because it was closest in dividend yield. And they pay $2.46 a year per share in annual dividends. The share price for Cedar Realty Trust at the time of this filming is $3.03. The share price for BP is $38.83. So what I wanted to figure out was how many shares it would take to equal the annual dividend of BP. How many shares of CDR would it take to equal the amount of dividends that BP pays per share? So what I did was I took $2.46 and I divided it by 20 cents, and that gave me 12.3. So we need 12.3 shares to equal the same amount of of annual dividend income that BP kicks off. So we would have to buy 12.3 shares at $3.03 to get the same effect of buying one share of BP at $38.83. So in other words, it costs you $37.27 to get $2.46, or it costs you $38.83 for $2.46 with BP. Now, which one is the better buy? Well, you can argue BP is a more stable company, has better cash flows, definitely much larger. You're talking Cedar Realty Trust has about a $250 million market cap versus BP's billions. And you can do this for any, Ford was another one that can fit here. AT&T can fit here, roughly. So you can get a quality stock and get the same amount of dividends instead of getting a riskier stock and having to buy more to get the same effect. Does that make sense? I hope it does. If that doesn't make sense to you, please leave me a comment down below and maybe I can clarify that somehow in a video. But if you have any other questions, comments, or anything, leave them down below as well. Please like, share, subscribe. We'll talk to you later. Thanks. Bye-bye.